And what I'm going to do today is I'm going to teach you in this segment, what I have learned in the past 31 years of being a financial advisor, things that can help you avoid losing thousands of dollars and really kind of identify where there are opportunities in today's market. Number one, what you want to do is avoid emotional reactions to short-term volatility. And I think for 2025 was the first time investors have gotten tested in the last couple of years with the volatility that we had regarding tariffs. And, if you look back and think about a time in history where maybe you made an emotional decision with your investments. I know, as an example, I had owned a social media company, and I was kind of frustrated with the social media company because of all of the ads. It seemed like, every ad I saw, and it would be, 1 out of 10 would be something would be more so what I thought the social media was designed to do is share updates on friends and family. But because I saw the ads, I got really frustrated with the company. I sold it too early, and that stock has really continued to appreciate as well. So looking back, think about a time that you made an emotional decision and what that impact was on you. We had met a gentleman, and he had come to one of our events. It was Tom. Tom really was not in favor of the previous administration. So under the Biden presidency, he came out to our event. It was in October of 2023. And what he had told me at the event is he had told me that he moved all of his money out of the market, moved it into a bank CD, and he was going to stay out of the stock market up until Biden was out of the office. So again, making a decision based upon who the president was. Now, assuming that he stayed in cash, I went and I looked at the S&P 500 index. And although you can't invest directly into the S&P 500 index, but from October of 23 up until here May of 25, the S&P 500 index has been up 55% since then. It's fair to say that if he did go over into even a high interest money market account or a CD, not even close to those type of rate of returns. So those emotional decisions, you can see real life examples of how that can hurt you. What I want you to do is I want you to have an investment policy statement in place. And inside of the investment policy statement, what it's going to do is it's going to outline the possible outcomes of what could happen to your portfolio in different market environments. With today's technology, there's a lot of companies that can help you figure out what your overall risk number is. We use software, it's called Nitrogen Riskalyze, and in that software, the first thing that it does is it helps somebody pinpoint anywhere from 0 to 100 what level of risk they're taking. 0 would be like having your money in a bank, 100 would be cryptocurrency. And then it would show what are some of the outcomes during 95% of market conditions. So you could call those your guardrails. And what I want you to do is I want you to first look at that number and look at what your guardrails are and say, hey, if this happened in my situation, would I feel comfortable with those outcomes? And if not, you'd want to make a change before something bad would happen because you could be much more likely to become an emotional investor if your portfolio risk score doesn't line up with who you are. And within your investment policy statement, I want you to then start to identify specific steps that you're going to take during volatile market environments. This is like what I would refer to as running the fire safety drill. There's going to be times when the market takes off, it goes up a lot faster than it has. We saw with the tariffs, we saw really what's called a V pattern market, meaning that the market dropped quickly and then immediately really bounced back here with the recent more comfortable that the federal government was and more comfortable that the president was with where tariffs are going to be, ultimately leading to investors to feel more comfortable here recently to get back in the market. So again, a V-pattern market. But if you had specific steps, and maybe those specific steps are, if the market drops more than 10%, I'm going to buy X. Or if the market drops more than 15 or 25%, if you have those set aside and set ahead of before something bad happens, it's going to allow you to then take advantage of where some of those opportunities are. And the same would be true is like if and when the market goes up or your investment goes up, If it goes up, greater than 10%, greater than 15%, these are the things that you would do. Maybe at times you would sell and lock in some profits. That's going to help you identify in your investment policy statement ways to avoid making those emotional decisions. The next thing I would tell you to do is avoid watching your portfolio on a daily basis. I love logging in and looking at my account when the markets are doing great, right? So it's always fun to say, today I made X thousands of dollars based upon what the market did. But if you look at the market on a short-term basis, again, my experience of working with hundreds and families is those people who look at their portfolio on a daily basis are the ones that tend to make more short-term decisions that can lead to poor long-term performance. So try to look at your portfolio just on a quarterly or annual basis, or, again, during those volatile markets, pull out that investment statement and say, what action should I take if the market is out of normal? Rebalance your portfolio on a set schedule. That could be every 6 months you'd want to rebalance your portfolio. Or again, you could do the rebalance when the market overreacts, like what we saw here recently with the market dropping 15% from its highs. And avoid those news headlines and ask, will this news headline matter in 5 years? So again, ask your question about tariffs. Will that matter in 5 years from now? And if you say, it really doesn't matter in 5 years from now, then maybe you don't need to make a short-term decision. So that's number one. Number two, what I want you to do is I want you to know what you own and really understand each of your investments that you own. Know the goal for what each account is. There was a lady, Vicki, that we recently met with, and Vicki had a lot of money built up into a taxable brokerage account and had a large position in a money market mutual fund. Now, the great thing about it is, as we've talked about on the show, money market accounts are some of the highest they've been in the last 20 years, so she's earning a lot more interest than what she's used to. She's got good dividend-paying stocks, but the problem is, in that taxable account, what Vicki is doing is when she files her federal taxes, she's paying taxes on that dividends and interest that she earns. In this case, she ended up paying in about $9,500 of additional taxes on money she wasn't even using. Your goal here in her situation is to move money from taxable to tax deferred to tax free. If she wanted to defer that money, she can try to put more of the money into her, say, company-sponsored retirement plan if she feels a little bit limited on what she could do there. There's things like moving it into tax-deferred annuities. If she really wanted to shift it over to more tax-free money, she could utilize things like max funding Roth IRAs. She could utilize strategies within the life insurance industry. And also she could utilize municipal bonds. Keeping it simple, municipal bonds could be a good opportunity, again, just to reposition some of that shorter-term money market account, earning the same or higher tax equivalent interest and moving it to the tax-free category. So looking at your tax return, identifying how much you have in taxable dividends and interest, and don't just voluntarily pay those taxes. Know what you own. Tom, in his situation, his concern and asking him the question, if you had a healthcare emergency in the future and you needed some type of long-term care, what would you do to pay for that? And what Tom had told me is that he had about $150,000 saved up in bank savings designed for an emergency. I love the fact that Tom identified money that he's going to utilize for that purpose in the future. The problem is, in his situation at the bank, he's really not earning much interest. And his example, what we were able to do is show him how he could take a portion of that money and move it over into a life leverage plan. So he's moving it from taxable interest to moving it to potentially tax-free money. He's picking up the added benefit of some tax-free life insurance. So if he never needs the money, he could leave a bigger legacy to his spouse or his children, whoever he names as his beneficiary. Or if he needed some type of long-term care, his deposit has been almost doubled. So sometimes you could see double or triple your deposit. If you put in $50,000, it could be worth anywhere from $100,000 to $150,000 if at some point you needed long-term care. leveraging those assets as well. And again, when I was talking earlier of the example of the social media stock that I had sold out a little earlier on, my goal of that account was really growth. It was the growth part of the portfolio. So instead of being frustrated with ads, I really should have done more homework and looking at, the amount of revenue that those ads were driving in and why the stock has continued to do so well with driving in that income. The next thing I want you to understand is I want you to understand the risk associated with it. Again, software allows you to look at your investment policy statement. And your investment policy statement is going to look at the big picture, everything as a whole, but you can also drill down and look at the specifics. A website that I like is Morningstar.com. I can go into Morningstar, and it gives me a lot of the analytical information like dividends, what's the price to earning ratio. I have a version that tells me what Morningstar thinks is the fair value. I can look at, return on equity. I can look at comparables. It helps me determine and really know what the risk is. In companies, again, like Morningstar, it allows you to understand and know what the cost is. So I can go on there. If somebody owns a mutual fund, I can see what some of the operating expenses are in that fund. I can look at comparables. I can say, how is that fund doing versus its peer group over a 1, 3, 5, 10-year time frame? So are you paying for, what you're getting? You want to know the tax impact. I give you a couple of examples of voluntary taxation, but there's a tax impact even on things like deferring money in your 401k in a traditional 401k versus a Roth IRA. I myself, even though I'm a high income earner, I choose to put money into our company Roth 401k because I believe tax rates could be higher in the future. And so I want to know what the tax impact is. I'd rather know now and pay now versus what the tax rates could be in the future. If you're using a third party, meaning that you're not the one making the investment decisions, your local advisor is not making the investment decisions, know what their methodology is and know what their investment process is. So how are they picking the investments that are in your portfolio? And if you don't know, ask your advisor because you want to know your investments, number two. And the third one to know is not knowing what you make and focusing on what you can keep. It's not always just about getting, say a 10% rate of return. That would be great, but if you turn around and you're, losing 20% of in taxes, is that really a good investment? So again, trying to focus on what you keep is very important. In Vicki's account, we had talked about the fact that she had a lot of taxable dividends and interest in a brokerage account that she was reporting on her tax return, causing her to pay $9,400 in excess federal taxes, even though she wasn't even spending the money. Tom's situation was he was able to increase the legacy that he could leave if he had never had a healthcare crisis to his family versus his savings account. And those type of things, when I had sold the social media stock, there's a different taxation if I hold a stock for less than a year. It's called short-term gains, meaning you pay ordinary income. And that could be a higher rate than having a long-term capital gains, which could be 0 to 15%. So again, knowing what you can keep is very important. What I've learned also from having a tax planning business, Retirement Tax Partners here that Danny runs, is just because you got a refund doesn't mean that your taxes are great. When you look at your taxes, whether you got a refund or whether you owed, that is not the determination whether your taxes are good or bad. It's a matter of understanding the system of taxation, identifying there are opportunities on where you can work to try to reduce taxes even more this year or in the future years or for your legacy as well. Again, the goal here is to shift money from the taxable to the tax deferred to ultimately tax-free category. Owning the right investments is going to help you try to reduce and or eliminate voluntary taxation. Every year you want to schedule an annual review and look at your taxable gains and losses on your non-retirement accounts and understand how that works in your situation. So in conclusion here, don't just file your taxes and put them away. What you want to do here is get really a tax what if done. You want to understand the rules when it comes to investing. How you kind of put this all together, number one, is avoid emotional reactions by having a rules-based system in place. Number two, know exactly what you own, and that will help you stay more committed to your investments once you understand the risk and the potential payoffs. And third, it's not just what you make, it's what you keep, and figure out a rule to keep the government away from your money.